Hello and welcome to Strategic Alternatives, the RBC Capital Markets podcast, where we uncover new ways to raise capital, drive growth, and create value in an ever-changing world, with insights and outlooks from our capital markets experts. Today we're sharing a conversation between Vito Sperduto, head of RBC Capital Markets in the U.S., and Lori Calvasina, our head of U.S. equity strategy. Vito and Lori recently sat down at RBC's Global Industrials Conference in Las Vegas to talk about the key themes shaping equity markets right now and how investors are thinking about and factoring in the potential impact of the upcoming U.S. election. If you're interested in getting fresh perspectives and a nuanced, data-driven view on U.S. equity markets, you can also subscribe to Lori Calvasina's weekly podcast called Markets in Motion, available wherever you get your podcasts. Now, let's dive into the conversation.
Our rate strategy team was calling for a 25 basis point cut, even the 24 hours before the cut happened from the FOMC. And our rates trading team, so notice the traders, they were calling for a 50 basis point cut. Obviously, one got bragging rights over the other. Some pretty interesting things. I think our rate strategy desk talked about this. The first cut is the deepest, kind of referring to the Cat Stevens song. And there's some great stats out there that I was looking at today. Mike Ventura, in his Industrials ECM newsletter that came out on Sunday, was talking about the fact that there's been 3 other cutting cycles that have started with a 50 basis point cut. 2001, 2007, and 2020 in the pandemic. Yeah. So put the pandemic aside. Interestingly enough, in those other 2 years, a year later, the S&P was 20% higher as you kind of went into the cycle. And then there's also been, a number of occasions where, as we've done cuts over the years, where there's been 20 occasions where stocks have been at all-time highs when a rate cut has occurred. And on each of those 20 occasions, a year later, the S&P was higher. So maybe let's just start with sort of the view as you look at this, Lori. Where do you see it impacting your market from a U.S. equity perspective, especially given the backdrop of what's happened and the forward look now?
Yeah, so we put some slightly different stats in the Pulse on Monday. And, this was something I've been working on over the weekend. But we did do a study where we looked at all cuts and then the first cuts. And I started in 1989. Starting points end up being important, but generally we have good sector data starting in 1989. So we kind of used that starting point. And when we looked at the first cuts 12 months later, generally I think the median return on the S&P was up about 11%. So obviously, there are maxes and mins, some that are better and worse. But we thought that was sort of an interesting starting point, because if you do the math versus the September 18th close, so the day after, the day of that meeting, that would actually take you to around 6,200 on the S&P next fall. And that's an interesting number because that keeps coming up in my work. So I'll just, give you the disclaimer, which I have not put out an official 2025 S&P 500 price target. Whenever you put it out, everybody always wants it earlier. So we've started the last couple years just running the models early and talking about what we're seeing in the various models. We have 5 different models that go into the targeting process, but one of them is our valuation and earnings model. And so over the weekend, I was updating all the stress tests associated with this model. And the model, by the way, is based on data going back to 1962. And I apologize for all the math, but for those of you who don't know me, this is just who I am. Yeah. And so we go back to 1962. We have trailing average S&P 500 PE data. We basically just built a fun little mousetrap where we use PCE, 10-year yields, and Fed funds to project the PE, and we multiply that times some earnings numbers to come up with a market, implied market fair value based on where you think interest rates and inflation are going. And so anyway, I have 3 different stress tests that I've run. One on the Fed SEP, so we got that update last week. RBC House Views, which our rate strategy team updated last week. And then just the published consensus, so just what is the word on the street. All 3 of those stress tests against my earnings model for next year point to around 6,200 on the S&P for next year. And if I take consensus earnings, which is a little bit higher, it gets you up to 6,500. But I will tell you, I did a big mid-year outlook back in July where we did all of our models for next year, and the median of those outputs for next year at the time was 6,150. So, I keep coming up with this idea that we are looking for gains next year. Now, when I do my valuation work in the short term, Again, I updated all the numbers. Tells me we're basically full for the moment, right? The fair value number I come up with is a little over 5,600, and that doesn't mean we can't go higher than that. But I do think, my colleague Jason Daw made an interesting comment on a call we did yesterday, and he said, we have to start thinking about how much we're borrowing from the future in terms of further gains that we get this year. And I said, I think that's a really apt comment. I think we're increasingly, with every move we have in the market in the short term, we're going to be talking about how much are we borrowing from the future.
As you think about that borrowing from the future, what are some things that potentially cause it to pull back if they don't get it, that you think are priced in already?
So, I do think at this point in time, it's pretty consensus that we're not going to have a recession, and I'm certainly in that camp. I think the economy is pretty solid. But, we are sitting with valuations that are relatively full. If you look at sentiment on the AAII survey, and this has been a great North Star the last few years, when you get to one standard deviation above the long-term average, you typically have a bit of a pullback in the S&P, and that's been true over time as well. And we're kind of flirting with danger on that model right now. I think our latest reading was a little over 20% on net bulls last week.
Yeah.
One standard deviation is 22%. And so we're getting there. On a few of the weekly data points, we've poked our heads above it. That 20% number I gave you is a 4-week average. So sentiment stretched, valuation is stretched, and we're still sitting here. We got this big fat rate cut from the Fed, and as you mentioned, in my history, I started in 2000. These things only happen when things are going badly. And as I listen to the financial media, some of the other commentators out there, they're still kind of probing the recession narrative. So I think it's, economic fears coming back. We've also got an election, and you typically do see a market pullback in September and October of an election year. You do get the year-end rally, but we've got to work through that. So I think those are all, sort of issues on the table.
Yeah, we'll get to the election later on, but it's interesting. When you look at the narrative, it seemed that when you splice the words that Powell used, clearly balanced it appropriately, sort of a confident in command message that, kind of positioned the 50 basis point cut appropriately, kind of told him what he's looking for going forward, and, kind of led people down the soft landing path with a higher probability, right? So.
Yeah, and look, I do think, there's always danger in consensus views. I tend to be a little bit more contrarian in my thinking, and it's not necessarily a comfortable place for me to be part of this consensus right now. But I think when you're sitting at expensive valuations and stretched positioning, you're vulnerable to bad news. And so I think we are, unfortunately, I think in that period right now, if we get it. That's a big if, but it's still a vulnerability.
It's interesting, just a lot of the conversations we're having with all of you and others from a client perspective in my sort of banking side of the house. I would tell you that, there's a narrative out there in terms of a lot of transactions pushing to the right, especially M&A discussions. I think there's still, very solid dialogue going on, and, good strategic deals are happening in terms of process. If there's something large, I think people are waiting till later in the year to kind of see how things pan out. But we're certainly seeing a pretty high level of activity in the financing markets, especially given some of the high values you've talked about.
I think one thing that's puzzling me, and Dean and Mike and Ken have all been nice enough to let me ask some questions in some of the meetings, and I did ask this. I don't know if you're in here, but I did ask this to one of the C-suite members this morning. But when we think about sort of the pressure from higher rates, right? We think of the cumulative impact there. We think of all the uncertainty around the election, and I've been seeing companies, not just here, but in earnings call transcripts, highlighting these as risks, as roadblocks, as things that are getting, people stuck. What unsticks us? We got the 50. How much more do we really need to see before we're going to get unstuck? With the election, what are people really looking for? Because I guarantee you tax policy is not going to be passed in 2 days. It's going to take some time to get figured out. So I think that's what I'm noodling over right now is what gets us unstuck, and it's just not clear to me.
Yeah, and interesting, so Lori's Pulse report, which is 100-something pages long every week.
It's like 120 now. I think it started out as 60.
A lot of great charts, and so if you're really into that, it was great. One of them was talking about the most likely scenarios from an election outcome. And right now, I think is the first week where we've seen the at 28% probability, Well, 27% probability is a Republican sweep of all three. 28% probability is Democratic presidency, Republican Senate, and Democratic House.
Yeah.
The split scenario,
Yeah.
right? Which seems to have been taken over a bit.
Yeah, so it's interesting, right? And I know we'll get more into the election later, but betting market data, it's got its flaws. Polling data it's all we have, right? Yeah. And so I do, sort of tell people I look a little bit more at trends as opposed to levels. I don't take them as gospel, but they do give you a sense of the zeitgeist and the vibes. And I just contrast what we're seeing there, right, where the Republican sweep scenario has faded, that Harris wins, split Congress has improved, and even the Democratic sweep scenario is a not so distant third, right? It's made it up to the 20s now. Yeah. These are all in the 20s. I had a dinner last week with Blake and Amy. Our derivatives desk put together a great hedge fund dinner. Every single client at that dinner said Trump was going to win. I am not saying they're wrong, but it's in contrast with what we're seeing in other data sets. So when I talk about the uncertainty with the market, it's not so outcome-based. It's just that there are dislocations.
Yeah. Interesting, those different pockets seeing different views. Why don't we talk a little bit about some of the positioning you're seeing amongst clients? And we've certainly, in the last few years, talked a lot about the Magnificent Seven, which is a whole new terminology. I always thought back, I'm going to date myself to the Western, but in terms of the equity markets, what do you expect for the rotation trade going forward? And
so I think it's tough, right? And I've got a bunch of my salespeople here, Chris and Tripp and a bunch of others, and I always feel bad when I get on the morning call, right? Because I think for someone sitting in their seat, right, you need a clear, simple message. And I don't have a clear, simple message on that right now. But if I'm being intellectually honest, I think these rotations have gotten started. I think it's going to be a process. And I think when we get a few years out, we're going to look back and say it got underway. That being said, a lot of people in this room who run money have shorter term pressures on them. So if I'm trying to sit here and say this is, what we're going to see, for the next 3 months, right, or the next year, I get a little bit less certain about that. Mm-hmm. Now, when I look at the growth side of the trade, mega cap growth, I see valuation ceilings that have been hit and positioning ceilings, that have been, frankly, breached, but pressure. So CFTC data on the NASDAQ 100 futures hitting new all-time highs, right? This thing is not cracking, but we look very overbought there. If you look at top 10 S&P 500 names in terms of market cap, these stocks cannot breach 30 times on a forward PE. They poked their head above their 32, went right back down, and now they're sort of sitting around 27, 28. So we've got these pressures in place. Earnings growth is decelerating rapidly. So if you think about, sort of the Mag 7, they had their earnings recession in 22, rapid growth in 23, and now they're coming back down to earth and are projected to go from I think 30, 40% to 15% next year. The rest of the market had its earnings recession in 2023. It's reaccelerating and recovering now, but it can't quite catch up to the Mag 7. So I've been updating this one chart since January that's still showing an advantage on net income growth for the Mag 7 relative to the rest of the market. And the rest of the market's trying to catch up, but it just can't quite get there. And I think that's why we just keep seeing this trade going back and forth and back and forth and back and forth.
So is there, you've covered a lot of the small cap historically. Is there more going into that area as a result of the rotation, or
so I think
there's a slight rotation?
The small caps are looking a little bit better to me lately, and I've been, kind of neutral. And for those of you who don't know me, I covered this space for 7 years exclusively, so it's still very near and dear to my heart. I still talk to a lot of people in this space. On an earnings growth or net income growth basis, it is expected to take over the Mag 7 next year. The problem is nobody believes small cap earnings growth data. Yeah. There's just not as much coverage. There tend to be quality concerns with both the analysts and the companies, and it's not a slam dunk, right? There's just not as much confidence in those numbers. But if you look at positioning, something really exciting happened in that 120-page deck last week, which is that the CFTC data on Russell 2000 futures positioning broke out to a new post-COVID high. And there had been a ceiling in place that we hadn't seen breached recently. And if you looked back in kind of December, January, last year, this year, the last time people got excited about the Fed and hedge funds dumped a bunch of money into passive small cap products, we went right back up to that 3-year ceiling, that post-COVID ceiling, and we fell back down. Now we have poked above it.
Okay.
I think that's really, really good. The valuations aren't that cheap anymore. They're at average, but they're certainly better than the rest of the market or the Mag 7. I think for small caps, and I think this ultimately solves as well for what gets that rotation out of Mag 7, mega cap growth going, it just goes back to the economy. We're sort of stuck in this economic pothole, and we've heard hints of that today, right? When we're still hearing companies, express some nervousness. You need the economic tailwinds to get back, to get faith in those earnings growth numbers for small cap and for that really kind of more cyclical part of the market to outperform. I think a lot of the Fed is baked in, but now it's really just up to the economy.
Do you, when you think about the economy, do you focus on the resilience that you see out there? Do you think it's more noise that people are concerned about versus looking at their own business's performance? Because it still seems like there's always like an analysis we're looking at as to how much of it is it noise versus reality.
So I think sentiment data, survey data generally looks worse than hard data.
Yep.
And if I even think about some of the surveys, I forget, I'm blanking on who it is. I think maybe it's the Duke CFO survey, but one of these surveys has a great time series on companies' confidence in the economy and confidence in their own companies.
So the conference board does a phenomenal survey.
Is that the conference board one?
CEO confidence. Duke does the CFOs. Yeah.
But there's one of these, right, that just shows a gap, and the doubts about the economy are greater than the doubts about the ability to manage your own company. And what I think I really see, I read through lots of earnings call transcripts, really try to take a bottom-up approach to the job. And I see companies that know how to save costs by pulling other levers besides firing people.
Yep.
I think that's a big change since 2015, 2016. I also think the labor market is just structurally different.
Yeah.
So it makes it more difficult for companies to really want to pull that lever. And I think that's one of the big things that's saving us. And I think on the other side with consumers, I do think the post-COVID psychology still matters very much, and consumers are not proactively pulling back. They are clearly reacting to inflation, but it is to rearrange spending for other things that are more important. And I think that economic modeling is based on, 20, 30-year relationships where the psychology was very different. I think that, I'm not an economist, right? I'm a strategist. The economics community, not my guys, but street-wide, they keep missing everything. They miss inflation, they miss GDP. They don't know how to forecast the post-COVID economy.
Yeah.
Right, and I think it's because of these psychological and structural differences. So the boots on the ground, I see the resilience. And I also did a study where I looked at post-GFC to pre-COVID. GDP forecasts on the street generally started out too high and had to be revised down. That was a constant of that time period. Post-COVID, with the exception of 2022, we generally start out too pessimistic and have to ratchet up. Yeah. I think you've got a lot of people running around in the investment community that started in the business around the GFC, and all they've ever known is excess optimism, and now we're dealing with excess pessimism.
So that comparison is, we were just talking about it in a couple sessions where when you looked at, for example, companies have been hoarding cash since the 08 GFC, right? Yeah. Because so many got caught and they don't want to be in that situation. So I think cash balances today are much higher. But the point about the GDP and then the reality of once it gets revised, that's pretty interesting. I hadn't thought about that.
Yeah, and
it is the truth. You see it out there, right?
Yeah, and it's just one of my lived experiences, right? And I started back in 2000, right? And so I think a lot about muscle memory and where can you go wrong as an analyst. And one of the big problems I had, kind of probably in the middle years of my career, was being too bearish on tech, because I grew up in the middle of the tech implosion. And now I see a lot of people who have come into the business in that kind of 2009 through 2010 timeframe. Their muscle memory is the GFC, and they're over-indexing to that.
Yeah, I'm just starting to forget about the 90s, so I'm in a different time frame here. But let's get a little granular in terms of sector specifics. I mean, we're sitting here at the industrial conference, so how's this sector looking to you right now?
So hopefully I get invited back next year. Look, this is one of my all-time favorite sectors in terms I always manage to find a way to be at this conference. I love listening to the companies. We divide up sectors on my team in terms of who reads what, and I take industrials and tech. And so I have an affinity for this sector. I'm neutral right now. one of the things that has restrained my enthusiasm, I know Dean's here, I do a quarterly survey with my analysts across the whole department. And my industrial analysts, they don't feel terrible about the world, right? But what we've seen over the last few quarters is they've regularly kind of clocked in a bit cooler than analysts in, say, energy or financial. So I'm overweight those two sectors. That's contributed to my sort of more neutral view on industrials, is that my boots on the ground, people who know the sector better than I do, are not among our most enthusiastic analysts. The other thing is that I look very seriously at kind of two quantitative metrics from my work, the rate of upward revision, so earnings sentiment. We look at it both earnings and sales. And those numbers are actually fine for industrials. They're not really knocking it off the cover, but they're fine. Valuations are a problem on both a relative PE and a forward and an absolute PE. Forward multiples, medians, not just indexed to one stock here or there. Like the median multiple based on data going back to 1989, we're basically at 2 standard deviations above the long-term average on both the absolute and relative multiple right now. The sector that had that place a year ago was tech. We actually downgraded tech in January to neutral. So I think the earnings backdrop is fine. I think companies are managing through challenging conditions pretty well. Obviously we've had some fiscal tailwinds in recent years, but I just can't get past the valuations right now.
Yeah. So it sounds like some other sectors might be looking a little more favorable, not that this one's unfavorable.
Right. I think I wouldn't be underweight, but I just can't get to an overweight right now. I will say I think sector is tricky. Sector selection is tricky right now. So we're overweight financials. We've been there a while. That one's playing out. It's, cheap on relative, kind of neutral on absolute. The valuation appeal is eroding a little bit, but we're in the middle of a really powerful sort of earnings revision recovery in the banks that, started when revisions bottomed out around SVB. So we've got some tailwinds there, right? They're big beneficiaries of the rotation out of growth into value. You cut rates a little, avoid the recession. That's kind of the sweet spot for them. So we're making calls like that, but I'll tell you, sector calls just, they don't feel great right now as a general rule.
Okay. Well, that's very helpful. Why don't we finish up in terms of the election, which obviously has taken up the air in the room now that we've gotten past rate cuts. And, I think as we mentioned, I think we're seeing activity, but at the same time, I think some of the larger pieces, I think folks are waiting to better understand the outcome before they're making decisions. But, do you see, you mentioned the hedge fund client base being very focused on a Trump preparation. Like, are you seeing clients prepare for the two scenarios?
The truth is there are just differences between U.S. investors and non-U.S. investors. And so I feel like I'm still regularly getting inbound calls from European clients, from Canadian clients, Australian clients. And to be honest, the conversations with Europe have been really, really in focus on this event since last June. And I don't mean June of 2024, I mean June of 2023. It has just been highly in focus for that non-U.S. investor base for a long time. And so they are still the ones, hey, can you send me the playbook on what to buy or sell, if Trump wins, if Harris wins, yada, yada, yada. My U.S. investors are not really asking that question right now. I had an analogy early in the year when we were still in primary season, and I used to say the election is like staring at the sun when you talk to your typical U.S. investor. They kind of like look up and squint, and they have to look at it for a minute because they're getting questions from their clients. Yeah. But then let's get through it as quickly as possible and look away and talk about something else. And it's starting to feel like that a little bit again. I think if you look at policy, right, and it's such a hard topic to talk about. Yeah. And I think there's sort of the non-U.S. people don't quite get that, the U.S. people do. But I do think what we care about, right, is domestic policy. We didn't really have that much of it to analyze until recently. So we had looked at Trump's campaign website in the spring and early summer, and there were some bullet points. At right before his debate with Harris, they put up a 16-pager, right, PDF. Yeah. And so we had more stuff to look at there. He did a speech in New York. I went to that. It was really focused on his economic vision. We got that in early September. Harris, the Sunday night before the debate, finally put up some campaign proposals on her website. So we have looked at all this. We're not following every detail that's coming out in a rally or an interview. We just can't keep up, and we don't know how serious that stuff is. Yeah. but we are looking at the official platforms. And we went through issue by issue, and we really just tried, to look at our own top-down equity market read-throughs. And I'll tell you, on taxes, there are major differences in terms of what you do for the tax cuts that are expiring for upper income earners. Yeah. There's a lot of similarities between both candidates in terms of wanting to expand the child tax credit or restore it, extend the tax cut on lower income earners. So there are some similarities. If you look at other issues that the stock market cares about, right? On trade, one candidate obviously wants to take a more extreme approach, but the other is not exactly on the other side of the spectrum. So my point is, we went through and looked at all these issues, and there just aren't major gaps. It's not clear to me, other than like if you want to buy alternative energy under one scenario and sell traditional energy under the regular scenario, or maybe flip them for the other candidate, like that seems to me a major, just one's here, one's here. But there's just not a lot of stuff like that right now. So I think that's what, the U.S. investors who are really, kind of digging into all this stuff, and even, if you look at certain issues, right, like taxes and tariffs, right, like those one might be a positive, one might be a negative. So I think that there's just a lot of weeds to get lost in, and U.S. investors seem like they're ready to wait and see.
Well, those press conferences and rallies that you ignore. So there was a comment that's been making the rounds this morning where Trump was berating John Deere.
Yeah, I heard about that one.
For planning to move some manufacturing down to Mexico and hitting them with a 200% tariff.
I'll give you a great quote from Halima Croft, right, who's our real DC expert. And back at some point in the last year, I call Halima and I'm like, Halima, I'm getting all these calls. Yeah. And she's like, Trump was very situational. People need to remember that. And I think she's dead right on that, right? And so we can look at all these things. It's time to do the work. It's time to do the thinking. It's not time, to really pull the trigger on a lot of these things. And I'll give you one other example, right? The speech in New York. So taxes, right? Clear difference. Harris wants to go 21 to 28 on the corporate tax rate. Trump has floated going, I think, 21 to 20, and then he's also talked about going 21 to 15.
15, yeah.
The speech I saw in New York a few weeks ago, he tied it very clearly. You can get 15% for domestic producers. What are domestic producers? I know there are a lot of companies in the S&P 500 that wouldn't fit that category, right? There might be some. I have not been able to find out what he actually meant on that, but that seems like a pretty important qualification. So I have some colleagues, right, and our peers in the strategy community who are adjusting their earnings models for a 15% tax cut. It's premature to do that.
Yeah. Well, we'll see how it shapes up. So just in closing, I would echo Mark's comments earlier, really encourage you to subscribe to Lori's research, listen to her writings, and if you happen to miss it, then just turn on CNBC or Bloomberg, and I'm sure you'll catch her on a daily basis. So it's all out there.
Thanks for listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on September 25th, 2024, and originally took place at RBC's Global Industrials Conference in Las Vegas. If you'd like more information or to continue the conversation, please contact your RBC representative or visit rbccm.com/strategic alternatives. To stay up to date on all the latest capital markets trends, subscribe to Strategic Alternatives on Apple, Spotify, or wherever you listen to your podcasts. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.